So good afternoon, everybody. I want to welcome you back to the next installment of Market Matters. Today, we'll be reverting back to the shorter format and hit a special topic at the end that I find really interesting in today's market. It's an area of the markets that it's not getting a lot of attention right now, but we think it will be interesting to introduce, and I think it'll be worth your time. So let's see here. Let's turn to the agenda for today. Very similar to prior patterns, we're going to review the COVID-19 fact pattern that's still impacting, I think, a lot of the way we're thinking about the world and the markets in general. We're going to move to the economic and investment implications associated with that. And then finally, as I alluded to in the invitation, we're going to talk a little bit about the municipal bond market and how COVID-19 is impacting that end market, because I think it's really underappreciated right now. And it's just something that needs some further attention. Additionally, we got some great feedback from the prior episode with our first guest speaker, John Tousley from Goldman Sachs. And because of that, we've got, in the future, we'll be putting out a little bit longer of a calendar, but we got looks like for the next 2 weeks, we'll have guest speakers on differing topics. One's going to be on cybersecurity. Another one is going to be on the energy market. So we think that'll be a really good use of your time. So let's turn to the COVID-19 fact pattern. Now, this is a little bit different look than I've shown in the past, but I think it still, tells a very similar story. And what you can see is, I think it's important now to look at the global number of new cases, because there are a variety of regions of the world that are, moving through this infection pattern. And there are a couple parts of the world that are continuing to have some issues with the virus itself. So, you can see here, I think, case study and how to handle this particular issue or particular viruses in South Korea. I think they're only reporting now, 13 new cases as of May 2nd. Mainland China is now 0, which is great news. But then you've still got new cases coming up in places like the United States and the UK. And I'll show you what that means, what we mean by that here on the next slide. So this is a picture of the United States, and this should be a little troubling to everybody because, we just reopened a number of states. And, for a variety of reasons, I understand all the economic reasons why governors are very keen to open up states rapidly because of the economic consequences. But I think what you're seeing right now in the United States is the consequence of that kind of bespoke or disjointed approach. You can see, whereas in New York City, which is the kind of epicenter right now, or was, new case counts are going down, the 7-day moving average is collapsing pretty dramatically. The rest of the United States is not, it's moving in an upward direction, which means that other parts of the United States are now starting to have, issues with the virus. And part of that may have to do with the fact that we've got a disjointed approach and no unified, national approach to this. But it's just something to keep an eye on, because this is really, I think, disappointing to see for a lot of us that have been staying in our homes pretty fastidiously under social distancing, observing social distancing, and restricting movements to only key or critical movements. That this is part of the dynamic. Now, part of this might be that better testing is starting to occur, and it looks like, by all accounts, we'll have within the next 2 weeks the ability to test upwards of 500,000 people a day, which is very positive. But that, despite the fact, we've still got a little bit of a rise nationally in the number of new cases. But of course, there are some new breakthroughs that we need to obviously keep an eye on. This is one reason why I thought that this particular virus wouldn't necessarily be as intractable as potentially the Spanish flu, is what I went over on our first Market Matters, or second. And that is because you've got a lot of different solutions in the pipeline at various stages, some of which are existing, some of which are nascent or upcoming. But I guess the point is that ingenuity in the scientific arena right now is much more dynamic than it used to be. And it's really hard to model how breakthroughs will occur, but it looks like, by all accounts, they are starting to occur. So, Gilead's remdesivir drug got emergency use authorization from the Food and Drug Administration to treat COVID-19 as an actual treatment. Now, this only would apply to critical cases and emergency cases, but some of the anecdotal evidence would suggest this is helping at least some people. And then also there was an interesting story I read about a groundbreaking discovery of an antibody treatment that prevents infection of COVID-19 that was originally used for SARS way back in the 90s. So some scientific breakthroughs are occurring. It's occurring at a very rapid rate. Part of that has to do with the fact that now information sharing amongst medical institutions is far greater than it ever used to be. Talk to anyone at Emory right now, Emory Medical Facility, and they'll all tell you they have a high degree of connectivity now to other professionals. So I think this is a really good dynamic. Just some other interesting articles to touch on. You know, local jurisdictions were now starting to get into this murky territory of states' rights, which, you know, is a bit of a problem to some degree because it could lead to differing outcomes in different parts of the country. But some, you know, I guess this is in the other direction. Local jurisdictions are now forcing the closure of beaches, like in the case of California. Governor Newsom has shut down a lot of the LA beaches because they were just mobbed. Whereas other places like Florida are opening without any issue or without any real, I guess, considerations other than the local economy. So it's just something that we're monitoring, and it also would play into the final special topic today about the municipal bond market. New York Times article here, another great one. This group, this Oxford group, is now leaping ahead as far as moving to phase 1 trials for their vaccine. That's much farther ahead of schedule than I think most had anticipated. Most had anticipated clinical pre-trials starting to occur in the fall. And here we are in the spring with one group at least starting with their first round of trials. And then finally, this is just important to note that there are ways to solve this particular issue or at least address it much more aggressively. In the case of Vietnam, this is another case of similar to China. They saw the Chinese experiment or experience with it and how they locked down certain areas. Vietnam has taken contact tracing one step further and isolated not only those that have it, but their family members and put them into government-run university barracks, university dorm rooms and military barracks, basically enforcing isolation for upwards of 2 weeks. And consequently, they have, you know, no deaths yet and only 300 cases. And this was as of last Friday. So I think that it's important to just understand how powerful this the social distancing and contact tracing is in this whole equation. And the reason, you know, again, go back, I see one of the questions in the queue. The reason we focus on this is because it's hard to get confidence longer term that we won't get a second wave of infections that will subsequently shut down the global economy if we don't get a coordinated effort globally to rid the world of this disease, or at least stabilize it and address the problem. That's why we keep addressing this. It's a key issue. Moving to the economic and investment implications, my favorite section. We're still looking to rebalance accounts at around the 2950, 3000 level on the S&P. That again, we didn't hit that. We got up to about 2940 last week, and we're still a little ways off, but we'll be doing that as soon as we get to that range. And that would entail trimming equities, given that we rebalanced back in March, and adding to things like equities, or adding to things like bonds and alternatives. Inflation hedging is becoming more of a priority. I think that's starting to show up in a number of different places. And there are ways, obviously, to address that, which we'll touch on later. Earnings season has driven the relative price performance, which I'll show you here in a couple of slides. But, you know, recent positive I would note that recent positive earnings reports out of small companies are likely temporary. And the reason I say that is because funding markets for small companies still, despite what the Fed is doing, are still very restrictive to small companies. And I think if you own a small business, you know what I'm talking about. Active management, however, is demonstrating significant performance potential, and we continue to allocate away from index exposures and some of our what we call our benchmark strategies that have some view of indexes incorporated into them. And matter of fact, in the benchmark strategy, I think we're at the highest level of active we've been for over 12 years. So fixed income as well, getting less attractive because a lot of the spread tightening that's occurred, meaning that interest rates have come down not only in the treasury market, but also in the corporate markets. We're very selective on the corporate side. And we're still trying to increase the quality of the portfolio, meaning, moving an average of triple B or single A rated bonds up to an average rating of A plus or double A potentially. And then finally, looking at the alternative sleeve, this tends to be the more esoteric or area that we can do the most with from a flexibility standpoint. And again, inflation hedging is becoming very cheap as a hedge, and commodities and commodity-related companies are now showing, I think, some really interesting risk-reward propositions, because as I'll show you in some subsequent slides, certainly the energy market is cavitating right now with significant amounts of shutdowns and the like, but also other areas of the markets, like the grains markets, with this trade war with China, that's really impacting corn farmers and wheat farmers out in the Midwest, putting downward pressure on prices because the demand isn't there from overseas anymore. And a number of other variety of industries, things like wood producing, lumber industry, or steel industry, all seeing shut-ins and rationalization of production. So let's turn to some economic data. We haven't touched on this in a little bit, but I think it's worth mentioning. This is a great chart series because the TSA puts this out every week, actually every day. They put out numbers that go through the TSA checkpoints. And what you have noticed is, I think this is part of the reason why some of the optimism in the market has started to come back, is that people are starting to get back on airplanes and do some traveling, primarily, I would guess, for business purposes. I'm not sure the motivations for a lot of people right now traveling, but it is good to see, at least for those that need to, are getting out, potentially bringing some more economic vitality back to the airline industry or airports and things of that nature. So people are going out, engaging in commerce, which I think is not a bad sign. Also, the construction side, this is really interesting, and it also dovetails nicely into the chart I showed maybe 2 or 3 weeks ago about retail sales. And one of the main places that has seen positive retail sales throughout this whole last 6 weeks or so have been home improvement centers like Home Depot, Lowe's, and Ace Hardware, actually, believe it or not. And what you see here is that construction spending, after dipping a little bit in March, is now rebounding pretty nicely on a month-over-month basis. Now, obviously, in absolute terms, this is obviously a loss year over year, but in relative terms, particularly month over month, just seeing any uptick is good news, because as you can see here, the survey for construction spending in the U.S. was actually a negative 3.5. Was supposed to be worse than it was in February, and in March, and April's come in at a +1. So that's a really big divergence in the data, which I think should not be overlooked. Well, also very positive, I think. So how are the equity markets dealing with all this? And again, I like to use this time frame because it really encapsulates steady state pre-virus, from January up through middle of February. Virus obviously shutting down most of the global economy, and now we're in sort of a little bit of a recovery phase. So what you can see here is that, after having rallied back up to about down 8 on the year, the S&P is now down about 12. And this is through the end of last week, which actually, I think that makes some sense to give some back. As you may recall, our base case here is actually for the S&P to probably move a bit lower from here over the near term, and then work its way out to a decent, single-digit loss over the course of the year potentially. That's the base case, not the best case. Best case would obviously be returning back to break even by end of year. Emerging market stocks, however, international stocks continue to experience the bulk of the pain right now in international and equity markets. Same with U.S. small cap stocks. And recall one of our, one of our big assertions has been that international would be underperforming. Both emerging markets or international stocks would be underperforming because of the problems that the U.S. dollar is causing internationally with terms of trade and borrowing costs internationally. And so that continues to play out because the U.S. dollar continues to be very strong through this whole recessionary period. And until that dynamic changes, we're not going to get that much more excited about international. I mean, yes, we are adding selectively here and there to a few positions, but it's not a broad-based increase in allocation. Let's move to the next slide here. Earnings, this is what I was telling you. This is the week, this week actually, for earnings and who's yet to report. After the bell today, we've got Walt Disney. That's going to be really interesting to see how they're dealing with the situation, given that the majority of their profit, not revenue, but profit, comes from their park system. PayPal is another good indicator because it's an electronic payments company, very similar to Visa, MasterCard, to see how consumer spending patterns are evolving throughout all of this. Uber will be interesting because it's one of the public, as I call them, public unicorns, which is some think it's almost too big to fail. I don't see why Uber's price couldn't get cut in half necessarily if funding costs were to rise, because they don't make any money profit yet. But those are all beginning earnings reports that we are going to be looking at over the course of the week to give us some indicators as to where we are in this earnings cycle. And I'll show you actually a print of the so far through last week where earnings are in just a moment. Looking at fixed income real quick, we've got, as I keep saying, this is a bit of a tricky story because, the government bond market, as represented by this red line here, the aggregate bond index, is back to levels as where it was pre-crisis. So, the 10-year Treasury bond yield is now at about 65 basis points. That's, pretty low by using any standard. Investment grade bonds, interestingly enough, after the Fed announced their support program for the corporate bond market, has actually trailed off a little bit in price. And that just means that investors are not necessarily believing fully that the Fed can support the bond market fully without any other investor interest. And it's, obviously pricing in some stress in companies underlying that corporate bond market. The high yield bond market and the emerging market bond market have really not done anything. And in fact, they've trailed lower over the last few weeks, which indicates to me that, those sectors will probably be challenged for the foreseeable future because, just supporting the bond market with low interest rates from the Fed isn't going to do a lot to help revenue with junk bond companies or companies that have a junk bond rating attached to them. It's not going to generate revenue. So that's an area we're watching very closely because it will be a good leading indicator as to where potentially the equity markets go over the near term. And just as a refresher, in any of our portfolios, we continue to have zero exposure to both high yield bonds and emerging market bonds. We haven't had exposure to either of those asset categories for maybe about 7 or 8 years. So here's a picture of the earnings reports that have been come out. This is through last Friday, and really interesting dynamics because if I were to pull this chart up from last week, you would have seen that the energy sector up through the end of last week, or I'm sorry, 2 weeks ago, was showing the worst results. From an earnings standpoint. That's actually not the case anymore. Earnings for energy companies have been better than expected, which is good. You can see that they're from a negative standpoint, only not even the worst performing sector. What's really gotten a lot worse has been financials and the consumer discretionary, the companies that rely on consumers to visit restaurants and buy goods and services and things of that nature have really gotten beat up. So that's really interesting to just point out because from March 30th to today, those numbers have changed a lot. The S&P has gotten a couple of percentage points better than the last time I showed this chart. It was negative 15, I think it was, for the S&P for Q1. Now it's negative 13. But look what's happened in both healthcare and information technology. Those sectors have actually shown much better earnings than were expected, even on March 31st, even after having a month of virus-related analysis behind them, and that's, I think, a good opportunity, because if you can allocate, particularly in proprietary strategies, and we've tried to do this as well for ours, allocate capital to companies in these sectors and not in these sectors, you're going to be your performance potential gets a lot better. It's only been recently we've been starting to add to energy names, and that's only after they've, in most cases, fallen 50% or more. So that's the earnings picture, and it's actually better than expected, so that's good news. However, this is one reason why I think we are going to be in for a bit of a sideways market for the foreseeable future, even trending down to the March level for over the near term potentially, and that is because of this chart right here. And that what it shows you is that the majority of the performance in the S&P thus far this year has been isolated in the top 5 companies of the S&P. You have Facebook, Amazon, Apple, Microsoft, and Google, up, believe it or not, 10% for the year as market cap weighted. The remaining 495 companies are actually down 13. Now, that's a gross generalization because you're lumping 495 companies together. Obviously, there have been some that have performed better than others, but it's just when the market breadth, is what they call that, gets this narrow, it doesn't bode well for the near term. Now, longer term, once this kind of rectifies itself through either the bottom 495 catching up or the top 5 catching down, that's when you get a better breadth of the market, meaning more participation from more companies, and we'll be looking for that breadth to expand as we get further into the cycle. And then it all goes back sometimes. I know I hear clients asking about this sometimes. When is value going to start outperforming, or quote unquote value going to start outperforming growth companies again? And here's a chart that shows you the ratio of growth to value, or value to growth. So if the line is going up, that means value is outperforming. And if the line is going down, that means that growth is outperforming. It's just a ratio. The higher the ratio gets, the better value is doing. The lower the ratio gets, the better that growth is doing. And this is a 20-year look back. And you can see it was a pretty wild ride. We're actually back to the levels we were back in the early 2000s. Almost down to those levels. So we've almost come one full cycle from this perspective. And I think I would say that, there are structural reasons right now that growth companies are outperforming. Typically they have asset-light business models, meaning that they don't have a lot of capital expenditure on property, plant, and equipment. They tend to have much more automation built into their business models. And I know all small businesses like us are trying to incorporate automation whenever possible. It's the capital intensive businesses like, the financials, the energy companies, the materials companies. Those are all doing pretty poorly right now because they need lots of capital to continue to operate, to sustain operations. And until that dynamic rectifies itself, I don't necessarily see a time in the near future when value is going to materially outperform. Now, what would cause value to really outperform would be if we saw some inflation in the economy. So the economically sensitive sectors like industrials, energy, financials, those are all economically sensitive companies. And they do really well when the economy is expanding, which is essentially what happened from 2001 to 2007. But when the economy is just kind of plugging along at a, ho-hum rate of between 1.5% and 2.5%, that's when the technology advantage from the growth companies really starts to kick in. So until we start to see higher levels of growth and thereby higher levels of inflation, I don't necessarily see this dynamic changing anytime soon. So we are value oriented, but that doesn't mean we're allocating heavily to financials, energy, materials, and the like. But, I do think there are some dynamics within certain markets now that are presenting some opportunity. As I mentioned, maybe in the beginning of this Market Matters series, energy, because of all the volatility in the price, was starting to look interesting. What you see on the screen right now is the Baker Hughes. So Baker Hughes is an oil services company now owned by GE, and they calculate all the oil rigs that are running at any one time in the United States. And what's interesting is that, there's been a really steep drop off in oil rig count. Actually, I've looked at a few earnings reports from oil producers, especially the smaller ones. And believe it or not, there are even some small companies that have cut their oil rigs down to 0 from 5 a year earlier, or 6 months earlier. And why would they do that? Well, it's just not economic to run those rigs if oil is priced at, below $10, below $20 a barrel. And when you start seeing some of these shut-ins, which means that they don't produce from viable wells, that just creates limited capacity, which is exactly what the oil markets need right now. So if you listen to any of the earnings calls from Chevron to Exxon, some of the majors and super majors, BP, none of them are getting very aggressive with their capital expenditures. As a matter of fact, all of them are cutting capital expenditures by anywhere between 25 and 50%. So that means there's going to be less money looking for oil in the future, or natural gas. And that, I think, is what's leading to some of the price changes that are occurring maybe over the last 5 days. Maybe you've seen it or not, but crude oil is now up, I think it's 30 or 40% in the last 5 days. Natural gas is more important for me because that's a power generating item that has more durability to its demand profile. But natural gas is now over $2 per million BTU. It's not been there for a little while. So I think the market is now starting to sniff out that once we get through this recent down cycle, we have some bankruptcies in the small producer space that we're really setting the stage for higher energy prices, potentially maybe back up to the mid 30s or 40s in the near, not too distant future. So that's an area that we find interesting. Still don't have a huge exposure there, but it's there are a lot of interesting opportunities there because the prices of call it either equities or master limited partnerships are really starting to reflect some distress, which is always not necessarily a bad time to be investing. So just for some summary comments here before we get to the main or the special topic, that is a sideways market, I think, is what we're expecting for the foreseeable future, with a possible retesting of the March 2020 low that we saw a couple of weeks ago. Earnings have been better than expected on average. That's certainly helping some sectors outperform others, and we're keeping a close eye on those dynamics. Index investing is becoming much less attractive with return dispersion rising, meaning the difference between stocks of similar style. And traditional methods of identifying value and growth, I think, bottom line, need to be revisited, because using the old, ways of attaching value to a company, I think, could be dangerous, because that would lead you to a lot of those economically sensitive companies. So with the time remaining, I did want to touch on the municipal bond market, because I do think it's a sleepy part of the market that really doesn't get a lot of attention until things start to happen in an adverse way. So just a quick overview of the municipal bond market. There are over 10,000 different issuers for municipal bonds. It might even be more than that now, with all the different economic zones that have come up recently. But that's a very heterogeneous market, which is very different from the corporate bond market, which has a few thousand, or government market, which only has a couple of different issuers, Fannie, Freddie, the U.S. Treasury, Ginnie Mae, and the like. Not all states are equivalent in risk profile. This is a big. This has been a big campaign for me, because I've been talking to clients ad nauseum about certain states and cities that present risk in their muni bond portfolios. And there are different things that impact a muni bonds aggressiveness or risk profile. That would be migration trends, demographics, industry type reliance, tax policy, amongst other things. Interestingly, and this is why I thought this was a good topic, current law states that no state can declare bankruptcy officially, right? So, if the state of Illinois wanted to declare bankruptcy, they couldn't use the Chapter 9 provision to go into bankruptcy to restructure. But we do have a recent example by way of Puerto Rico, where they were given authority, I think it was by Treasury, to use Chapter 9 authorization. So they're not a state, they're a territory. So maybe that was the nuance that some people were were, glomming onto. But I think, recently you've heard Mitch McConnell, House Speaker, talk about, or Senate Speaker of the Senate, talk about, how we should start letting states go into bankruptcy instead of continuing to fund their obligations from the federal level. So this is one of the first times I can remember in probably the last 20 years where I've heard that type of rhetoric being kicked around. And then, of course, you have the coming soon issues that are just starting to impact coastal states, which would be things like climate change. I'm not, climate denier by any stretch. You just have to recognize that water levels are rising, and just go to Miami. You can see all the pumps that are actively working in downtown Miami and in certain parts of Miami, to understand that it's not going to take a very big move in the water level to put a lot of places that were once inhabitable into the uninhabited space, or you just dam them up, or do like the Netherlands did. So that's a quick primer. So the key thing that I do want to focus on, and I come from this background, so I feel somewhat qualified to talk about it, and that is, underfunded pensions are a big problem that no one really wants to talk about, and also retiree healthcare. And these are what you're seeing in front of you is the percentage of state revenues that would be needed to fulfill pension and healthcare benefits under the current state of affairs with the COVID-19 impact in the red bar, and then assuming a 30-year plan return for the state pensions. What's happened recently, and the reason that they have these three here, the blue line might seem a little weird to you, but most states still assume a target long-term rate of return on their portfolios of between 7 and 8%. That's just started to come down over the years, but the problem that states face is, as you bring that what they call discount rate down, as you bring that discount rate down, meaning your forward return assumptions get lower, that means that the states will have to keep putting in more and more money to bridge that funding gap. And I think the reason I wanted to show this chart was because you can see some of a number of states in the Northeast, in central Midwest, Illinois being the worst one, but also places like New Jersey, Connecticut, Massachusetts, Maryland have some potentially big problems ahead of them. So, not to mention the pension funding issues, but also because there's no limitation to where you can move, people are just moving out of those states. Higher income earners are moving out of those states to flee not only rising taxes, but the growing pension and benefit obligations. So I guess to sum it all up, we are steering clear of any of these states right now within the top 5 and likely in the top 10. This is a great way to look at the pension. And so I get a report from, in this case, it was Piper Sandler, called The State of the States. And you can see, even though the credit rating agencies are rating this state of Connecticut as an A or an A plus in some cases, I think what these metrics right here, the pension funding ratio and the general fund balance as a percent of its expenditures, meaning that, how much do they have in their rainy day fund, should scare some people away. So in the case of the pension funding ratio, it's only funded 47%, which is a scary statistic considering we've had a bull market for the last 12 years or 11 years roughly. And so that is definitely something that we're keeping an eye on for any muni bond that we look at. Now, their general fund balance has been growing, which means their rainy day fund has been growing, which is good, generally speaking. But you got to wonder how much of that general fund excess is going to be diverted to this pension and benefit issue. Now let's look at Illinois, and this is obviously the train wreck that everyone saw coming to some degree, and still are investing in these bonds for some reason. Not us, of course, but they are one credit rating away or downgrade away from junk status. So that'd be the first state that I would ever know of that had been put into junk territory. Their pension funding is even worse than Connecticut at 40%. And go figure, they have no general fund or rainy day fund to fall back on. So I guess my point here is that this is a slow moving train wreck that if you don't have to invest in these areas, why even bother? And I think that's the way we approach muni bonds for the time being. And then this is a current state of where some of the healthier general rainy day funds are located. And you can see here, Wyoming, because of the oil and gas revenues, has a really solid rainy day fund. So does Alaska because of the petrochemicals. Texas, interestingly enough, but of course, the usual suspects down here below have nothing in a rainy day fund. So we'll probably be steering fairly clear of those. So anyway, I think that takes us to the end of our time today. And I wanted to thank you for joining us. If you do have any questions about some of the content or want to follow up on any of the items I presented today, please don't hesitate to contact your advisor. We do and can send out copies of the slide deck if you request it. So just let me know or let us know. And obviously, we would love, for those of you that aren't clients yet, we would love to be able to work with you at some point in the future. And we look forward to seeing you next week on our Market Matters that hopefully will have a nice, interesting guest speaker from the energy industry. So take care.